If you invested $100,000 into Fidelity versus Vanguard Index Funds today, which one would actually leave you with more money in your pocket 20 or 30 years from now? Most people assume that because these funds often track the exact same markets, the results will be identical, but that is a common mistake that could cost you thousands of dollars in lost gains. We are looking at the two biggest names in the investing world: Vanguard, the company that basically invented the index fund for the masses, and Fidelity, the financial powerhouse that has been aggressively slashing fees to zero to win your business. In this video, we are running a massive side-by-side experiment to see which fund provider is truly the best for your long-term wealth. We will reveal a surprising result that most investors completely overlook when they open their brokerage accounts. Stay until the end, because the difference between these two isn't just a few cents. It is the difference between an early retirement and working extra years just to cover fees. Choosing between Fidelity and Vanguard is the ultimate debate in the world of personal finance. These are the two biggest index fund providers on the planet, and for good reason. Millions of investors, from those just starting out at 18 to those nearing retirement at 50, rely on them to build wealth. Both companies offer products that track the exact same things, like the S&P 500 or the total stock market. Because the underlying investments are nearly identical, people often wonder why there is even an argument about which one is better. The truth is that while the ingredients are the same, the way the meal is prepared and served differs. To find the winner, we have to look past the surface level marketing and dive deep into the numbers. We need to talk about expense ratios, historical performance, tax efficiency, and the hidden advantages that can swing the needle in one direction or the other. This comparison matters because your choice today dictates your financial freedom tomorrow. Let's set the stage for our $100,000 experiment. Imagine you have a lump sum of $100,000 ready to be put to work. You aren't looking to day trade or gamble on the latest meme stock. You want a reliable, long-term strategy. You decide to put that money into a standard S&P 500 index fund and leave it there for 30 years. For this comparison, we are using the heavy hitters. On the Vanguard side, we have the Vanguard 500 Index Fund Admiral shares, known by the ticker symbol VFIAX. On the Fidelity side, we have the Fidelity 500 Index Fund, ticker symbol FXAIX. Both of these funds buy the exact same 500 largest companies in the United States. If Apple goes up, both funds go up. If the market dips, both funds dip. They are essentially mirrors of each other. Before we run the actual numbers and look at the fees, I want you to make a prediction. Which one do you think comes out on top after 3 decades? To understand why one might beat the other, we have to talk about expense ratios. The expense ratio is the silent wealth killer. It is the annual fee that the fund takes out of your investment to cover its operating costs. Even though these numbers look tiny, they compound over time, just like your gains do. Currently, the Vanguard 500 Index Fund Admiral shares has an expense ratio of 0.04%. That means for every $10,000 you invest, Vanguard takes $4 a year. Fidelity, on the other hand, has been undercutting the competition. The Fidelity 500 Index Fund currently sits at an expense ratio of 0.015%. That is just $1.50 for every $10,000 invested. On a $100,000 investment, you are paying $40 a year to Vanguard or $15 a year to Fidelity. It seems like a negligible difference right now, but when you factor in 30 years of market growth and compounding, that gap starts to widen significantly. While fees are vital, we also have to look at historical performance. If both funds track the S&P 500, shouldn't their returns be identical? In a perfect world, yes, but in reality, there is something called tracking error. Tracking error is the difference between the fund's return and the actual index it is supposed to follow. Sometimes a fund manager can actually perform slightly better than the index by using smart techniques like securities lending, where the fund lends out its shares to other investors for a small fee and passes that profit back to you. Over the last 5 and 10 year periods, Fidelity's FXAIX has actually edged out Vanguard's VFIX by a razor-thin margin. This is partly due to that lower expense ratio we just mentioned, and partly due to how efficiently Fidelity manages the fund's internal transactions. However, performance alone doesn't tell the full story because we haven't talked about the most aggressive move Fidelity ever made. Fidelity introduced something that Vanguard has yet to match: the zero expense funds, specifically the Fidelity Zero Large Cap Index Fund, or FNILX. As the name suggests, the expense ratio is literally 0%. You pay nothing to the fund manager. This was a revolutionary move designed to pull investors away from Vanguard. If you put your $100,000 into the Fidelity Zero Fund, every single penny of market growth stays in your account. However, there is a catch that most people miss. These zero-fee funds are often proprietary to Fidelity. This means if you ever want to move your money to a different brokerage, you might have to sell the fund and pay taxes on the gains rather than just transferring the shares. This introduces a level of platform lock-in that many veteran investors find uncomfortable. It is a massive advantage for cost savings, but it comes with a strategic trade-off. This brings us to a crucial topic: taxes and fund structure. This is where Vanguard often fights back and wins. Vanguard has a unique, patented structure where their ETFs are considered a share class of their mutual funds. Even though that patent recently expired, Vanguard's long history of tax efficiency is legendary. If you are investing in a taxable brokerage account rather than a tax-advantaged retirement account like a Roth IRA, taxes are your biggest hurdle. Vanguard's S&P 500 ETF, ticker symbol VOO, is incredibly tax efficient. It rarely triggers capital gains distributions, which means you aren't hit with a tax bill every year just for holding the fund. While Fidelity is great for low fees, Vanguard is often seen as the king of tax efficiency for investors who have high balances in taxable accounts. If you are 35 years old and building a massive bridge account for early retirement, those tax savings might actually outweigh the small difference in expense ratios offered by Fidelity. Let's examine the huge result. We estimated $100,000 over 30 years with an 8% yearly return. Based on current expense ratios, the Fidelity and Vanguard funds have $5,000 to $5,000 difference in ending balances after 30 years. You'll get $5,000 extra by choosing the fund with the lesser cost. With the Fidelity Zero Fund, that margin might be greater. If you were in a high tax rate and utilizing a taxable account, the tax drag on a mutual fund versus an ETF might wipe out your savings and put Vanguard back in the lead. It's not life-changing. You'll be a millionaire either way if the market performs, but it may buy a pleasant vacation or a new car in retirement. Who really wins? Your situation determines the solution. If you want the lowest costs and invest in a tax-advantaged account like a 401k or IRA, select Fidelity. Their zero expense and ultra-low-cost index funds are the lowest way to own the US economy. Younger investors who desire a slick mobile experience find Fidelity's platform more modern and user-friendly. Vanguard is a fund-owned corporation, thus investors own it. Vanguard is the safe bet for taxable brokerage account investors who desire a proven ETF structure and world-class tax efficiency. Vanguard wants to be stable, not flashy. For most investors, either one will perform almost identically. The competition between these two giants has been the best thing to ever happen to the average person because it forced fees down to almost zero. The real key to winning this game isn't just picking between Fidelity or Vanguard, it is the discipline to stay invested through the ups and downs of the market. Whether you choose VFIAX or FXAIX, the most important factor is the time your money spends in the market, not the tiny fraction of a percentage you pay in fees. Both of these companies provide the best index funds for long-term wealth creation. Now that you know how the numbers break down, I want to hear from you. If you had $100,000 to drop into the market right now, which provider would you trust with your future? Let me know in the comments below. Your journey to financial freedom starts with these small decisions, so make them count.